I'm Gordon Scott. I'm selected today because there's a lot going on in the US stock market that you might want to contemplate and think about. So I want to take you through a few of those things. I want to tell you today what is driving the markets. There's a lot of news, a lot of headlines about the political race that is going on, for president and so forth. And a lot of people feel like that is going to be driving the markets. I'm I'm of the opinion that that may have less influence on what's going on right now than the expectations of a Fed rate cut coming up here in September. And I want to show you why. So if in fact I can share the screen, let's see if we can manage that. Okay. And that's not exactly the chart I wanted to start with. Okay, here we go. And actually, I should probably bring up, there we go. Go switch over that and say it. So recently, the S&P 500 has had this big run up, very surprising drop. I mean, in terms of percentages, it's really not that much. Um, I mean, we went, from this peak here down to that. So that's about a 10% drop. I mean, well, more than 10, 11% drop. It's how fast it happened that was really shocking. And how fast that recovery has been since then is similarly shocking, right? That's unusual. You don't see an 11% drop in just that brief period of time and so forth. But I believe that part of what happens in markets is that you have this confluence of buyers or sellers, uh, and that you have a bunch of people that have, for whatever reason, their own rules or their own objectives or their age or anything that makes people want to sell. If a whole bunch of them want to sell at the same time, then you get these dramatic moves. If you also have a bunch of people that don't want to sell, but they want to buy at the same time, then again you get these dramatic moves. And what happened right here was in this particular drop here that started the selling was earnings. Earnings were coming through, and I mean, you look at the time frame where it started, right? Middle of July. That's right when the earnings season started. Prices had gotten to the point where they were pricing in just good news, just lots of good news, right? And we didn't get lots of good news in the earnings season. We got some bad news, and people thought, oh well, if companies aren't going to do that well, are we running into possibility of a recession? And there's some reason to consider the possibility of a U.S. recession. Look at this. This is the this is a chart that looks at the 10-year note minus the 2-year note. And this is what people have talked about, the yield curve. This is the easiest way to see the yield curve. If in fact the yield curve is positive, then that's normal. That's what people expect. And what the yield curve is uh, bond bond buyers paying more for longer term rates than for shorter term rates. So if you have shorter term rates at 1%, then you want to see longer term rates at 2 or 3%, right? Just, this is higher. Why? Well, because it's longer. And people have to tie their money up for longer. So that represents risk. So it's natural that they should want more return than for shorter term rates. If in fact it inverts, that the bond buyers aren't buying short term, and therefore that rate has to go up to entice more bond buyers in, And so that goes down. You know, you have 3% here and something less than 3% out at 10 years. If that happens, then that says that bond buyers see short-term risk ahead, and they want to be compensated for this short period of time, more so than the longer period of time. And that's called the inverted yield curve. When that happens, then this 10-year minus 2 years, if 2 year is bigger than 10-year, then it's going to make a negative number. Now, when the yield curve goes negative, it's everybody says, oh, that's a predictor of a recession because investors are seeing risk. And if all investors are seeing risk, then that means they're going to start taking their money out of markets because they're worried. And if they take their money out of markets, that's a confluence of sellers, and that is, a downward trend, which might indicate that the economy is going to go bad too. So that's the connection. The yield curve, expectations about the future, then the actual outcome of the future. That's how it all sets up. And what happens, interestingly enough, with the yield curve, is that the recession doesn't happen as soon as the yield curve inverts, as soon as it goes negative. It's when it stops going negative. Weirdly, it's once it stops going negative, right from that point, a recession is it's possible that a recession will start. As you can see back here, the most significant recessions in U.S. history are tracked right here in 1990. In 1998, it was just very brief, but there was this 98. Nobody thought of 98 as really a bad time economically, but that was when long-term capital management blew up, and there was this quick drop in the markets, similar to what we just had, 10% drop really quick, and then it came right back up. Then we had 2000 and 2001, and then recession started late 2000, early 2001, and that very very well known, very well remembered recession, right? And I should point out the back here that was the Asian currency crisis going on through here too. So, and then we have the big recession, right? 2007. Look at how the yield curve actually started inverting a whole year or two before the recession got going, right? Now, where are we? Well, we're here. We've had the biggest yield curve inversion from June of 2022 until now. It just flipped and went back up, right? Well, a lot of this is the COVID aftermath. Hey, that time was crazy. People were panicked. They stopped going to stores. The governments came out and did helicopter money, and so it really kind of messed up. And then for the next couple years after that, we had supply chain shock or supply chain interference, or whatever it was labeled, right? And so this looks really terrible compared to any of the past yield curve inversions. It's deeper and it's longer. Well, the depth and length, I think, like I said, has more to do with the whole reaction to COVID and the market having to absorb all that craziness and silliness that happened. I say silliness because, in my mind, governments shouldn't intervene as much as they do. I'm a believer in markets. However, that's some people say, well, that was really good because it could have been so much worse economically. Okay, I'm open to that possibility, but the point is it created a lot of disruption, and because of that disruption, you see this long-term period where we've had for 2 years an inverted yield curve. But the scary thing is it just came out. It just flipped back to positive. And I say scary. I mean, shouldn't that be good? Shouldn't we like that? Yeah, it looks like it should be good. But that's typically the period. When this happens, it's the period where all of a sudden you've got the potential for recession um, to occur in the U.S. And just recently here, we had the non-farm payroll uh, released, and this was, there it is, non-farm payroll employment change, okay? And the number was 142 when it was expected to be 164. So that came in way under. And the previous was also, I mean, you see it on the graph here, right? They were estimating it was going to come in here, and it came in much, much lower. And it's not like we've missed that number. We've never missed that number, right? I mean, sure, been off a couple of times. And that hasn't seemed to matter too much. But look at this trend. If I go back and open this up a little bit, from 2022, this is the time when the yield curve first inverted until now. Can you see what I see? This is just trending lower. And these last 2 months have gotten lower still. Now, in the big picture, that's concerning. That's very concerning, because we're coming to the time where the recession, the possibility of recession is increasing, and you've got well, okay. So back in 2023, no, sorry, 2022, summer of 2022, that was when the GDP went negative in the U.S., went negative for 2 consecutive quarters. And people looked at that and said, oh, that's the definition of a recession. So we must be in a recession, right? But the administration, the U.S. presidency that is still in right now, didn't want to have that sort of stigma. And so they instructed the Bureau of Labor Statistics and others to sort of say, hey, well, you know, usually that comes with unemplation. I mean, sorry, that comes with unemployment numbers. You can't have good employment numbers and a recession. If people are working, then it's not a recession, right? So, and that seemed like a pretty good point at the time, because, you know, these numbers were good. But since then, they have been on the decline. So if in fact we have GDP numbers that start to come out that are negative, and we have this lower inflation, then there's no holding back. There's no way of saying, hey, we're not in a recession. And if in fact we are in a recession, then investors are going to respond like that, right? So if they get in a recession, then investors start selling their money, or selling their stocks to raise money to just live on. Some do anyway. But here's the thing. In America right now, we've got 2 groups of people that have a larger concentration of demographics and money than others. And the first is people that are my age and older, people that are moving into or are in retirement, what was so-called baby boomers. But, you know, back in the time, there was the period coming out of World War II where a lot of people in America, you know, had kids, and so they that's the baby boomers, people born in that time. I was born in 1963, right at the very end of it, just a few months before John F. Kennedy was assassinated, right? So, which people count as the, you know, the end of the baby boom. So from people born in this period of time, they're kind of moving towards retirement age, and they're looking at their money in a short-term manner, because it's like, well, yeah, I want it to grow as long as I can, but then I don't want to pull out just at the last minute and then have as much money as I can to live on in retirement, right? But the second biggest chunk of people are their kids, right? I have children that are aged, were born in 1990, and the last one was born in 2001. So that 10-year period of time roughly corresponds to the what would be called Gen Z or millennials, sorry, millennials and Gen Z. They kind of a mix, but where they mix, that sort of demographic right there, that's the next biggest chunk of people in the U.S. right now, and those people are those young to middle adults. They are entering into the workforce and earning money, and as part of their money, they're putting, they're saving a lot, and they save into 401k accounts. And where does the savings of the 401k account? It goes into the market. I mean, whether they understand that or not, they know, well, I gotta invest in whatever choices I have. And the only choices they have are bond funds and stock funds. And stock funds do better than bond funds. So people put their money in stock funds, right? So what you see here, in my opinion, is this is people my age saying, yikes, there's risk. Let's get out of the market. And then there's the young kids saying, well, I don't want my 401k. I don't want my retirement savings to go down. I'm going to, buy more. And so I bought it right back up. So you got this little, interplay going back and forth. So Ashwin, hey, how are you doing? Asks the question, will lowest unemployment and recession cause a higher interest rate cut? Yeah, if in fact the Fed thought a recession was on the way, then their interest rate cut might be bigger. And that's kind of the point here, is you start looking at these, and I think what happened here is that because this all came crashing down, people said, oh, hey, the economy might be bad, and therefore the Fed will cut rates. Maybe if the Fed cuts rates, the economy's not going to be so bad. And so then it came running back up. And then in the past few days here, now that's a week. Oh no, that's daily. Okay. In the past couple of days, we've seen the markets tumble down, and that's in part because of these numbers that the unemployment, or the employment numbers were lower than expected, and significantly now for 2 months in a row. Okay, so here's the thing: are investors thinking, oh, a Fed rate cut will save us? And that's kind of goes to Ashwin's question, because, well, if the Fed sees all this, sees everything I'm talking about, and says, oh, we could be in for a recession, then maybe they're going to cut harder and faster, and then that's going to spur investors back into the market and buy up stocks, right? If that were going to happen, and investors believe that were going to happen, then you would see the S&P 500 making brand new highs. And by the way, what if we just overlay the NASDAQ on top of that? I'm not sure. Okay, there you go. You see, the NASDAQ is nowhere close to making a new high. So the S&P 500 got to its old high, but it stopped and started coming back down. So to me, as I read these charts, I am seeing this chart say, no, the Fed's not going to cut hard enough, fast enough, or in time. There is risk of economic downturn ahead. That's what that says. And look, the NASDAQ even is more adamant about it, because it didn't even make a new high, and it's almost heading back down to where its previous low was. Now, you think about NASDAQ. What is NASDAQ? NASDAQ is NVIDIA and Apple and Microsoft and Google and Facebook and Amazon. Those stocks collectively are where they go, the NASDAQ's going to go. Where the NASDAQ goes, the S&P 500 is going to go, right? That's just the natural thing. So right now, the market is telling us, hey, investors are saying, we see a lot of risk. People my age are saying, hey, maybe I'm going to move my money to bonds and not stocks, because the bond market's starting to look healthy, and I'm going to, move over. And younger investors, they're longer term thinking, so they're like, well, it dipped, so now's a good time to buy, right? And that's the interplay back and forth. But the idea that there could be more risk than, in the future coming than is being accounted for by the Fed or companies or anything else. That I think is what has markets spooked right now. Now, I think that it's possible that you could see markets have a tough time, but it's also possible that it won't happen just yet. Let's see, where's my, oh yeah, here's another chart. It's the S&P 500 again, but I'm going to overlay some things. Now, what I've seen in the past is that confluence of buyers and sellers can be tracked in some degree like this. If you have a period of time where the market, where the S&P 500 rapidly rises, then what that means is a bunch of people got in and they don't want to be day traders, right? People in the US, this is less true now than it was a few years ago, but it's still, the effect is still there. The idea is that if you buy stocks and you hold for an entire year, then if you take profits after that, you get lower tax rate. The gains that you've made come with lower taxes. That's called the long-term capital gains tax rate. A short-term capital gains tax rate is significantly higher. It's about double. So if you get charged, 10 or 15% tax on the gains you made in the market, if you've held for a year or more, that's the long term, right? Well, then the short term, that's going to be 20 or 30%, depending on, your tax bracket. So people don't want to sell until they've been a year out from when they buy. That's something I've noticed. And what I've done is here on this chart, track the last time. So if the S&P 500 goes up over the course of a 1 month period, 20-day period, by more than 7%, and especially more than 10%, this is true. If that happens, then about 56 weeks later, it takes that much lag, then you'll see selling. And what that means is people buy, it goes up, and they say, okay, now I can go ahead and sell because I can take gains at a lower tax rate. And if, some people do that, that's no big deal. But if a bunch of people all do that at the same time, if you have this confluence of sellers all at the same time that want to sell, then markets can really move down fast. And so what I look for are these periods of weakness, potential weakness in the markets caused because of buying earlier on. So if I look here, sorry, there's a lot of lines and it looks kind of goofy, but let me show you what I mean. Here's a period where the markets went up significantly. Here's another one. And if I go from these periods and I move out in time, 267 days, then from that point going forward, there's a period of about 2 months, which is potential weakness. The selling confluence could happen in that 2 month period, right? And as you can see, it did. That one topped out. Then another period came where did that one come from? This one here, where did that? Oh yeah, so that's the ending of this one here. And this one did not. This was a period of weakness, but people bought all the way through that weakness, right? Then right here, this is most, let's see, where's that one? Where'd that one come from? Oh no, I'm mixed up. Anyway, it goes back to this period, and this period. That's what we're dealing with now. This one here hasn't played out yet. But as you can see, whoops, there's these periods of weakness that show up. And this one was very significant. That called the market top. This one called the market top to the day. Very surprising. But that's the period we're in right now. And we're just coming out of that period. So I'm kind of expecting that maybe the buyers will take over and head back up. This is the last time we had very significant strength in a 1 month period. And I'm looking for it, 267 ahead, to become another period of weakness. And this is end of the year, 18th of December, right? So between now and then, we could probably get a rate cut. We've got the U.S. elections coming on. People don't like to make big decisions, coming into an election. It's happened before, 2008, that happened. But see, when that happens, here's the important thing to notice. If in fact you get a big market downturn coming right into the election, the September before the November, if in fact you get that huge market downturn, then what happens is the incumbent party loses power to the other party, because people use that in the recent, like, the economy's doing bad. Well, let's vote in a different party, see what they can do, right? And 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 so investors who are, large investors who are for one party or the other, they if they're for the incumbent party, they don't want to do anything rash because they don't want to hurt that party's chances of getting reelected, right? So, if in fact you have a lot of people in the U.S. that want the incumbent party to win, the ones that are in office right now, if they want them to win, they're not going to go crazy selling, right? But once the election is done, then if they don't like the person that got elected, or if they just, hey, it's bad, my guy got elected or my gal got elected, but I don't care. The market's bad. I've got to pull my money now, right? See, that's going to correspond with this time frame right here in December. Or worse, what if there's, a contested election that drags on from November through the end of the year or something, right? Markets hate uncertainty. So this is a very vulnerable period for the market, which is, end of the year, December coming up into the beginning of the year. And so that corresponds with the sort of long-term, hey, we could have a recession because of the, inversion, the inverted yield curve now going back to zero. All of that could come together and be really scary times. So we've got on the horizon potential for a big, big market downturn in the U.S. Will it happen? I don't know. Maybe it won't, because you've got all these young workers who are becoming more and more productive, more and more profitable, and they're just, saving more and more money. So as long as we don't get huge layoffs in the U.S. and we still get positive jobs reports, it might be just fine. But if it's going to go bad, I believe that is the period of time where the markets are most vulnerable, where a confluence of sellers could come in right now. Between now and then, I think there's less vulnerability for that to happen. I could be wrong. We could see a big market downturn. But I'm giving you all the reasons why I think we probably are going to see a Fed rate cut, which should prop up U.S. markets, and should sort of hold the U.S. market steady. All right, now, if in fact we're going to see a rate cut, what's that mean for Forex traders? Well, you should know. You should know already. If you don't, interest rates are the main drivers of currency valuations, right? If I have an economy or a nationality that has really good interest rates, then the currency in that country is going to do better, right? So Euro USD, let's have a look at that chart. This is, notice that just in the same period of time over the summer where U.S. markets have, kind of gone up, hit a ceiling and struggled, right? The euro has been strong. Why is that? Well, it's simple. People are worried about a rate cut in the U.S. If in fact the U.S. dollar gets a rate cut, if the Fed makes a rate cut, then the dollar will become less attractive. And less attractive compared to the euro means euro trending higher, right? And so we just had the euro pull back significantly here. What's that all about? Well, right up until that jobs number, people thought that maybe there isn't going to be a rate cut. Maybe the Fed's going to be okay with it, because the Fed doesn't want to. They talk like they don't want to cut rates if they don't have to. And so I think people got the idea, hey, maybe a rate cut's not coming. Then those job numbers came out, and oh yeah, there's a rate cut coming, right? And so it's kind of heading back up. The other one here is the U.S. Dollar pair and the yen. I don't seem to have that in my list for some reason. This is the U.S. the value of the U.S. dollar compared to the Japanese yen, and look at this period of time, you know, July until now, and what do you got? This huge drop, right? This has a lot to do with the Bank of Japan raising its rates and the expectation that the Fed is going to drop rates, and so this is just falling off a cliff. I mean, that's a little. You know, not as you know, zoom out and it's not quite as big, but compared to drops in the past, it's, you know, it's all that, right? So the expectation here is continuing expectation for a rate cut. Between these two things, if the Fed does cut rates, you will see the US dollar drop. And here's the weird thing. Once we get into recession, even though the rates are going to drop further and further, all of a sudden the US dollar will spike. US dollar, when the news gets bad in the US, when recession happens or catastrophe happens and the markets start dropping, first the dollar's dropping, but then all of a sudden the dollar shoots up in value, even though the rates haven't increased, even though the rates are decreasing. That's because people are worried about global risk, global economic contagion, and they just sort of look at the U.S. as having more staying power than most other nations if, in fact, there's a global recession. So that's why that happens. But that's probably not anywhere near on the horizon. So probably what you have for this next period of time is the likelihood that the euro will trend higher and that the dollar yen pair will trend lower. So I see for the next 2 or 3 months sort of, you know, volatility, but you know, sideways trending prices in the U.S. Stock market, the euro rising and the dollar yen falling, and all of that are my reasons why. So that's my market update. I hope that was useful to you. Before we check out here, any questions that you might have? Just get the chat window up so that if you do have questions, type them in and I'll be able to respond to them. We got just a minute or two before we close up here. All right. I'm not seeing any questions come in. Ashwin says, learned a lot. Thanks, Gordon. You're welcome, Ashwin. You're welcome. Happy to see you guys again next time we come around. Until then, everyone, take care and trade well.